Hello and welcome to the July 2026 webinar between First Mortgage and London Ambulance Service. For those of you who haven't attended these webinars today, it should take about 25 minutes to run through all the slides. Slides are on screen. And today's topic is based on moving home while managing your mortgage. So we'll be basically discussing a few items today, including what is the buying and sales process when wanting to move house, and in what order you do that. What the next steps are before you look to put your property in the market and before you look to make an offer on a new property. And we'll also be touching on flexible lending criteria available through all LAS staff, available through First Mortgage, as well as a quick market overview for 2026. So for those of you who haven't spoken to First Mortgage or attended one of these educational webinars between London Ambulance Service and First Mortgage previously, first of all, who are First Mortgage? So First Mortgage, we are a whole of market mortgage broker, and we offer a fee-free advice and application service for all London ambulance staff, as well as all NHS staff as well. So we'll look at the benefits of being an NHS employee in terms of how that favours you for mortgage applications over the next few slides as well. So a very quick welcome to all NHS colleagues today. Today we're going to help to understand your options when looking to buy a new property, and if you've got a property to sell. We'll look at why moving house is different from buying your first property. It's a little bit more stressful. There's more to do than when buying your first home. Can you buy before you've sold? Often the answer is no, but there are other options available, including bridging finance to be able to buy a property if you see a property you buy and you're not in a position to sell your home. We'll look at how much you can borrow as an NHS staff member. Typically, most lenders will let you borrow anywhere up to 4.5 times income. We work with lenders that can borrow anywhere up to 6 times, if not 6.5 times income, to really multiply your income and maximise the affordability for you. We'll look at market predictions for 2026 in terms of interest rates and mortgage rates. And there's always an opportunity to book in a free one-to-one consultation with any of the First Mortgage experts. You'll see on every screen of the slides, our details are included. So you've got our website at firstmortgage.co.uk. Email address for the team here is hellobath@firstmortgage.co.uk. Feel free to email the team to book in a consultation, or give us a call on 01225 970 830. That's 01225 970 830. You'll see that our details are enclosed on every page of the slide going forwards. So who are First Mortgage? First of all, we are an award-winning firm of mortgage and protection advisors. We've got over 33,000 five-star Trustpilot reviews. We are the highest rated Trustpilot review mortgage broker in the UK. And we provide the mortgage service for over 100 separate NHS trusts in the public sector, as well as working with the Ministry of Defence. In the private sector, we provide the mortgage service for the likes of Amazon and all their 90,000 UK staff, as well as a host of other businesses across the UK. And our advisors are highly experienced with dealing with NHS staff. We've dealt with thousands of NHS staff over the years, and we've seen it all in terms of all sorts of pay slips using different forms of income, from basic salary to overtime to antisocial hours to banding allowance. Whatever it is, we can use it and look at affordability for you to maximise how much you can borrow in the NHS or whilst working for the NHS. So our advisors are highly experienced in dealing with NHS staff. So our services include a fee-free mortgage advice and education service, including these webinars I present on a monthly basis. You get a free one-to-one consultation at any point with any of our advisors, and that's just not just one, that's ongoing support as well. And we'll also help apply for the mortgage for you and secure the best rate available for you. We'll take you all the way through from the start to the finish, guide you through to get a mortgage offer until you're moving into your new property. Along the way, part of our job is to ensure that you are financially resilient. So we'll make sure that you are protected financially alongside that new mortgage you're taking on. We don't want you to simply move into the property. We will make sure you can afford that mortgage now, in 5 years, 10 years, 15 years, whatever life throws at you. So we'll provide you with free protection review in terms of life insurance, illness cover, income protection, all of that kind of stuff too. We've got a flexible service. We are open 9 a.m. through till 7 p.m. During the week. Besides a Friday, which is open until 5:30, also open at weekends too. We've got availability to speak, say after work, on lunchtime for you, even at weekends, to work around you. So we are financial wellbeing specialists. Unlike a lot of the brokers, we're not limited to a small panel of lenders. So most brokers you speak to generally will access to around 6 or 7 lenders they can choose from. We've actually got access to over 90 separate lenders in the market and anywhere between 25 and 28,000 mortgage products on a daily basis. Our advisors are super experienced. At the British Mortgage Awards, our advisors in our office here have won a numerous amount of awards, including Best Overall Advisor, Best New Board Advisor, Best First Time Buyer Advisor, to name a few of the sort of national awards that our advisors have won along the years. So in terms of NHS workers, why do NHS workers receive special consideration? So before we dive into looking at moving house and what sort of the steps are, let's recognise NHS workers and why actually we dispel a myth that it's hard to get a mortgage working in the NHS. It's actually easier in a lot of senses. Reason being is that obviously public sector employment is seen by the government to be a much more stable environment, and therefore mortgage schemes are heavily supported for NHS workers who work in the public sector. It's a reliable income, it's a highly valuable social role, and there's also often a very strong demand for housing, with thousands of people working from any sort of NHS site. Because of that, a lot of lenders and different mortgage schemes often favour NHS employees in terms of lending criteria, so open up flexibility to lending criteria, including increasing multiples that NHS employees can lend to over and above what sort of the majority of the public can, as well as opening up different forms of incomes for obviously affordability as well. So that includes unsociable hours, it includes overtime. There are lenders that can use 100% of additional hours you do on top of your basic salary to really help maximise and help you buy properties. There's also a number of different mortgage schemes and government schemes available to you to help you A, get on the property ladder, and B, sort of look to buy bigger shares of your property now and in the future as well. So moving on to the main bulk of the topic today, which essentially is understanding your current mortgage before looking at moving home. So obviously today's topic is looking at moving properties whilst obviously you've got a mortgage in place and how to manage your mortgage at the same time. So when moving house, before you do anything, before you get on Rightmove and start looking at properties and working out what sort of area you want to buy in and how much you can afford to buy, look at your current mortgage. So understand what your current balance is, look at the interest rate you're on, whether you're on a fixed rate and you're tied into the current deal, whether you're on a variable rate, which means you can leave that deal without any charges and walk away from the current lender. Look at how many years are remaining on the mortgage term, whether you've got, say, 5 years left, or whether you've got 25 years left to go on the current term. Importantly, you need to make sure you're aware if there are any early repayment charges for leaving the current deal. If you're on a fixed rate, the likelihood is you've got early repayment charges for leaving that current deal before the end of that deal ends. So every mortgage deal you're either on a fixed rate or a variable rate. The vast majority of fixed rates have got early repayment charges or tie-in periods, which means you're tied in until that specific product deal ends, which means if you redeem that mortgage early, you'll get charged a fee, which can be anywhere really between 1% and 5%, depending on what products you took out initially. You also need to make sure that your mortgage product is portable, and portable essentially means that you can take the mortgage with you or transfer your current mortgage from one property to another, which allows you to have the same mortgage terms as you've got now, but on a new property without incurring any charges, because effectively you're then not leaving your current lender. All you're doing is taking your mortgage with you from one security address to another. Step 2, find out if you can take your mortgage with you. So speak to your mortgage lender, speak to a mortgage broker. Just by speaking to a mortgage broker such as ourselves, we can work out and find out if the mortgage is portable. So the majority of mortgages are portable. There's only a few specific products really historically that haven't been portable, which you're not allowed to take with you, which means you should, in theory, be able to take your mortgage with you to a new property. What that allows you to do, so especially in quite a high interest rate environment now, it would allow you to keep an assuming lower interest rate. Had you taken a lower interest rate in the past, you can keep that lower interest rate and transfer that rate to the new property. It may mean that by taking the mortgage with you to the new property, you can avoid any early repayment charges because you're porting the existing mortgage over. You're not therefore breaking the terms and conditions of your current mortgage. All you're doing is transfer the property that your mortgage is secured against. And it also might mean if you need to borrow more money because you're buying or upsizing to a new property, that less borrowing is needed on today's high interest rates. So I'll discuss that in a bit more depth a bit later on to explain that. However, porting the mortgage isn't automatic. So you'll still need, when you come to apply for a mortgage, to pass a credit check. So regardless of whether you've had a mortgage with Santander for 10 years, if you don't pass a credit check with Santander when you try and port the mortgage to the new property, they may well turn around and say, actually, no, we're not going to lend you on the new property. Even if you've got no missed mortgage payments, if you've got bad credit and you don't pass their credit checks, there may be no way forward. That is obviously worst case scenario. If that were to happen, you can speak to us. We can try and look to source a new mortgage elsewhere, but it may mean you'd have early repayment charges to face. Any existing lender would also look at new affordability assessments. So any material changes to the current mortgage setup albeit you're changing the term, you're changing the borrowing amount, you're changing the property. That is a material change to the existing mortgage application. That will require a brand new affordability assessment. So we'll look at your income and your expenditure to determine how much you can borrow based on the situation on the new property. They'll also require a new property valuation to be carried out on the new property that you're looking to secure as well, to make sure that property is structurally sound to lend against, and also it's worth the amount you're looking to buy it for, so the lender's willing to lend against it. So what the difference is between porting or transferring the current mortgage versus starting the new mortgage again afresh. So advantages of porting existing mortgage over: you're allowed to keep the existing interest rate, which is often lower than a relatively high interest rate environment where we're sort of facing for new rates and new applications right now. Often you can avoid early repayment charges by transferring or porting the mortgage to the new property. Often lenders will allow you to borrow extra money on a brand new product. So you then have two separate mortgages, the porting mortgage plus the additional borrowing amount. And the existing lender decides that they can basically switch you over to the new property. So often their terms are a bit more, I guess, flexible versus new lenders because there's a history of you borrowing money and paying money back on time to them. With a new mortgage, you have access to new products. The advantages being that you have access to products available in the current market, which might be a bit more flexible. You've got one simplified route of borrowing, so it might not be you've got a separate mortgage, separate mortgage parts where you've got a ported mortgage and an additional borrowing part. You've got a brand new mortgage in one, which is easy to manage and is simplified. And you've also got a wider lender choice in terms of having access to the whole market. Whereas if you port the mortgage over, you've only got access to one lender. So what to do when borrowing more money when moving property. So many borrowers need additional funds when they come to buy. The reason being is they're often looking to upsize and buy a bigger value property. House prices generally year on year tend to increase, and therefore more spare cash is needed to buy a bigger property. If family circumstances change, and for example you go from two adults to a child, or you go from one child to two or three children, often that means people need to move property, basically to have enough space for obviously the growing family, but also be able to afford their mortgage. So often the additional borrowing you need is called a top-up mortgage. So you'll often have an existing mortgage plus the new borrowing amount, which is the top-up mortgage, and they're on different mortgage amounts, on different mortgage products, on differing rates with differing terms. Okay, and different end dates to the product. So you have basically structured as on a brand new mortgage when you move property, you'll have the porting mortgage, and underneath that you've got the additional borrowing amount. So you've got two separate mortgage parts, which then form the brand new mortgage for you going forwards. And ultimately you'll then have one much larger payment based on, assumingly, you're borrowing more money. So in terms of how lenders assess affordability when moving, it's exactly the same process as if you're buying your first home, or even if you're looking to remortgage. So lenders will look at your income in terms of working out how much you earn, and how much you can demonstrate you earn based on your pay slips. They'll look at regular ongoing expenditure, things like credit card debts, any loan repayments, any car finance, any after school kids clubs, any childcare, any school fees that you pay for your children. They'll look at how many children you've got, how old they are, and up until what age they're going to be financially dependent, usually up until age 18. They'll look at future interest rate changes, and they'll basically work that into their algorithms to work out affordability for you. They'll look at your credit history, and they'll also look at monthly affordability to make sure that on a monthly basis you've got enough money left over from your net pay and all your outgoings to ensure that you can afford the mortgage plus all your regular bills and a little bit of spare change on top of that. So affordability is key when looking at moving property. It's not just about looking at the property itself and assuming you can take the mortgage with you. You need to ensure that mortgage is affordable, and you therefore need to be qualified financially by a mortgage broker before you look to buy a new property and move home. So when moving home, a common misconception or a common myth that people look at when moving property is they'll look at the value the house has increased by and simply work out the deposit from that. You also need to look at the balance and how much interest you've paid off the mortgage balance since you bought the property initially. So any equity in your current property, plus any additional savings you have on top of that, form any sort of, I guess, money pot. And the money pot is there to use towards paying for any fees to move, as well as the deposit to put down on the new property. So as a quick example, you'll see on screen, if you've got a current home value worth £450,000, existing mortgage at the time you look at your mortgage before you decide to move is £250,000 remaining, You've therefore got equity of £200,000. That equity is there, that's yours. So even if you put down, say, a £20,000 deposit initially 20 years ago, the equity you've got in terms of the difference between the house value now and how much you owe the mortgage is £200,000. That money is yours. So when you sell that, that equity goes to you. You can then use that equity towards buying a new property, albeit towards a deposit, or the fees, or both when buying a new home. Plus, you've got any fees on top of that to account for. So if you've got any savings, you can obviously throw that into the mix and have more money available to buy a new property. Okay, so fees when moving on to fees. So looking at moving home, you need to think about all the applicable fees when moving, because moving can be quite an expensive process. So first of all, valuation/survey fees to pay for on a new property, especially if you're buying an older property. It might be that you need to get a more thorough survey done, albeit a home buyers or even a full structural survey, and even a damp report done or a specialist report done on the new property. Estate agents' fees for selling your home, typically they're around 1% plus VAT, but they can be as much as 2% depending on the area in which you're selling or obviously the agent you're using. So that's 1% plus VAT of the actual sale price. So that'd be a pre-arranged contract you arrange with your estate agent that you market the property with. Stamp duty on the new home, because it's not your first home, there's no stamp duty relief. You will have to pay stamp duty on the new property. The higher the value of the property is, the higher the stamp duty will be. Again, speak to a mortgage advisor. They can financially qualify you and confirm how much the stamp duty will be to pay on the new property you're looking at buying. Conveyancing costs, so legal costs for selling your property, as well as legal costs for buying the new property. Typically, they range between £3,000 to £5,000 for both combined, but it depends on sort of the level of solicitor you use in terms of the service you receive. Removal costs for physically moving, so gone are the days where you pay £300 to £400, £500 now for moving home. You're looking at a minimum really of £1,000 and not £1,500 for moving, up to say £3,500, £4,000 for the top tier level, whereby you're getting the removal company to take down furniture and build it at the other end and pack everything for you, unpack it at the other end too. But if you're doing it yourself, obviously there's no costs. But if you are using a removal firm, I'd probably budget around £1,500 for moving costs on the day of moving as well. Look at any potential early repayment charges. So if you're not taking the current mortgage with you, if you're not porting the current mortgage, how much you're going to be in charge for the current lender, because that's going to come off the total equity you've got when you sell the property, because you have to owe the mortgage plus any early repayment charges on top of that to the current lender when you sell your home. Look at any arrangement fees on any new mortgages, even if you're staying with the current mortgage lender and you're taking on a top-up mortgage over and above the current mortgage balance owing. It may well be that new product has got an arrangement fee of, say, £999 to pay, which you can add to the loan, but take account of any fees you may incur for any new mortgage products you've got. All of those fees need to be subtracted from the overall money pot you've got. So when you sell the property, we worked out that same equation last time. So I take you back a slide where you sell your home for £450,000. You've got a mortgage of £250,000 remaining, which means you've got equity of £200,000 left. If you've got no savings and all you've got is the equity in the house of 200,000, you need to minus away all of those fees you've just run through from that £200,000 to work out how much the fees are going to be, to essentially then work out how much you've got left over to put down towards a deposit on the new property. So if those fees cost you £50,000 in total for stamp duty, legal fees, estate agents fees, removal fees, any mortgage fees you've got to pay, you'll then have £150,000 left over to put down as a deposit or collateral against the new property when you come to make an offer. So you need to do all of this research before you make an offer on a new property. So you need to make sure that you can afford that new property before you get on Rightmove and before you start viewing properties and before you start falling in love with a property that you can't afford and it's not going to work. Common mistakes to avoid when moving home whilst you've still got a mortgage and looking to manage a mortgage. So avoid looking at house prices before checking availability and affordability with a mortgage broker and being qualified financially. Don't ignore any early repayment charges you've got on the existing mortgage. They won't go away. You'll have to pay them when you redeem the mortgage if you redeem it early. Don't forget about factoring into account moving costs. So again, all those charges I've looked at, conveyancing costs, removal fees, any hidden charges. Speak to a mortgage broker, they'll be able to work it all that out for you and give a detailed list of any fees you may incur. Avoid making any large credit purchases before completion. So once you've got your mortgage offer in front of you, it might be it takes the solicitors 3 to 4 months to go through to completion. Avoid applying for any finance if you can in that interim time. Once the mortgage goes through, you're free to apply for finance. Avoid, if you can, changing jobs during the application. If you are going to change jobs because of your circumstances, speak to your mortgage broker before you accept a new job, before you resign from the current job, because it could have a significant impact on lending criteria and being eligible for that existing mortgage that you've already applied for. Don't assume your current lender is always the best option. Always shop around and speak to a mortgage broker who can do that for you. Our job as professionals is to find you the best rate, secure the best product for you, for your circumstances, and obviously help with that process for you from the start to the finish. In terms of a timeline when moving property, so when you own existing property already and need to sell and buy a property, the typical moving timeline goes as follows. So before you do anything, plan your mortgage. Speak to a mortgage broker, book an appointment with First Mortgage, or speak to any sort of fee-free mortgage broker to understand your circumstances and be qualified financially. So plan your mortgage, work out how much you can borrow, work out how much it's going to cost you before you get on Rightmove. Get an agreement in principle from your mortgage broker, which confirms in writing how much you can borrow based on your circumstances, subject to credit scoring, subject to affordability checks, and subject to full underwriting. Then, once you know how much you can borrow, once you know what the fees are going to be, and you know how much deposit to put down and how much money you've got left over, get on there and start searching properties, get on Rightmove and start viewing properties, start booking properties on ones you like. Okay, get your property on the market at the same time. So speak to an estate agent in the local area. Get some value, probably worthwhile speaking to 3 separate estate agents to get your property valued and get a good feel for who you want to use. Get your property on the market at the same time as you start your property search. Once you've had an offer accepted on your property to sell the property, once you've had an offer accepted to buy the new property, get in touch with your mortgage broker and let them know. They'll have no idea that you've basically had an offer accepted until you tell them. They'll then help you and guide you through the next steps all the way through to mortgage application, which includes evaluation being done on the new property and the underwriting done on the mortgage. That will then go through to mortgage offer. Once the mortgage offer has been issued, which is typically about 2 to 3 weeks after the mortgage application has been sent in, mortgage offer is issued. That offer sent out to you. It's also sent to your solicitors. Your solicitors will then deal with the solicitors working on behalf of the other party, of either the party selling the home that you're buying or the party buying the property that you're selling. And they'll basically draw up the exchange of contracts. So you'll get contracts sent through weeks later, both to look through and scan through, make sure you're happy. You'll then sign that. You've then exchanged and you're legally bound to sell and buy the property. And a completion date is then set for you to move in to your lovely new home. That whole process typically can take anywhere between 6 to 12 months, depending on how long it takes to sell your property, or how long it takes to buy the property. It can be as quick as 2 months. It also depends on conveyancing and how quickly solicitors can move as well. The mortgage planning process is really straightforward. It takes 30 to 40 minutes to have a conversation with a financial advisor or a mortgage broker to work out the situation, how much money you've got to be able to put down for the new property and how much you can budget towards. It's then over to you to search for the property and start the process and let us know once you've had an offer accepted on the property and you're ready to move forwards. Key takeaways when looking to move home whilst managing your current mortgage. So be aware of your current mortgage and know the current details. Help is available from a mortgage broker. If you speak to a mortgage broker, book in to speak to one of our team here at First Mortgage, who can do that for you. Understand your options. So understand what your mortgage options are, how much you can borrow, how much you can afford in terms of monthly payments, what rates you're eligible for. Budget for all costs in terms of those costs we ran through. So conveyancing costs, removal fees, valuation fees, mortgage fees, any charges. Plan before viewing property. So you don't want to fall in love with the property and your family fall in love with the property without understanding if you can actually get it. So speak to a mortgage broker, get financially qualified, ensure that A, you've got the money to buy it, and B, it's going to be an affordable mortgage for you going forwards. Independent advice can make that process simpler. So book in, speak to the team here as a call to action before you look to get on the property ladder and buy a new property. Before you sell the property, make sure that it is affordable by speaking to a mortgage broker. So moving forwards, looking at how much you can borrow as an NHS employee, as I mentioned at the start of the webinar, the majority of lenders out there have an average income multiple of anywhere between 4 and 4.5 times income in the mortgage markets, which means they'll let you borrow up to 4.5 times your income. First Mortgage, however, work with a number of lenders because we're a whole of market broker. We've got access to a lender called Principality Building Society, which will lend you automatically up to 5 times your income, regardless of whatever your job role is or job title is, as long as you've got an NHS payslip. So that's available to you as long as you've got a minimum of 5% deposit or 5% equity in the current property you're looking to remortgage or buy, regardless of whatever your job role is, 5 times income. Speak to the team here. There are other lenders available. Depending on the situation, we might be able to get you up to 6 times income or even up to 6.5 times income, 6.5 times your income to borrow for a new mortgage, depending on eligibility for sort of those different mortgage schemes available. But speak to one of the mortgage brokers here, experts with the NHS, and we can guide you all the way through that process. In terms of financial protection, at First Mortgage, we offer the financial protection advice on protecting yourself financially. Our job is to make sure that you are financially resilient and you can afford the mortgage now and in the future. So why not book in a one-to-one consultation if you've got life insurance in place already, you've had that for a number of years, or any protection policies. It's always worth reviewing them. There are a number of new policies released every year by a huge amount of insurers with access to. We want to make sure that you are covered financially and you are prepared for all of life's eventualities. So speak to the team here. We can provide you with financial protection advice alongside the mortgage too. As regards a quick mortgage market overview, so where are mortgage rates now? Mortgage rates have shifted up a little bit in the last probably 2 or 3 weeks with swap rates increasing. Swap rates essentially is the rates that lenders lend to each other in the interbank market in the background. Just 1 o'clock today, an hour and a half ago, sorry, 12 o'clock today, an hour and a half ago at 12 p.m, the Monetary Policy Committee met for their latest meeting to look at the Bank of England base rate, and they decided to hold the Bank of England base rate again at 3.75%, despite looming increases in inflation. The reason probably being is that inflation has held relatively well over the last 3 or 4 months, despite oil prices increasing significantly. The general consensus from industry experts and economists is that we're through the worst cost of living crisis now, but we are coming through a period of unsettlement, with the Iran conflict having a huge impact on shipping costs as well as oil prices, affecting the global economy. We are therefore expecting that the Bank of England base rate may have to shift up at least once between now and the end of 2026 because of looming higher inflation costs looking to come. So base rate held today, 30th of July at 3.75%. We are anticipating, however, one further base rate rise up to 4% by the end of 2026. In terms of the inflation increasing, I said that inflation is likely to really jump up in the next 2 or 3 months before dropping back down, having a bit of stability in November, December 2026. And moving into 2027, mortgage rates are likely to remain a bit inflated, but should stabilise and start to drop slowly as inflation becomes back under control in sort of Q1 2027. So I hope that's been a useful session for you. So if there's an opportunity for any questions or to book in a free one-to-one appointment simply by contacting the First Mortgage team here and speaking to one of our mortgage experts. Again, our details, you've got an email address there at the bottom of the screen, hellobath@firstmortgage.co.uk, and you've got a telephone number to call 01225 970830. That's 01225 970830. Hope you've enjoyed today's session and hopefully look forward to seeing you at the next educational webinar at the end of August. Thank you.